Goldman Sachs rounding out second quarter earnings season from the big banks, and, well, it wasn't pretty. Profits tanked 58%, hit by write-downs in the company's consumer and asset management businesses. Embattled CEO David Solomon told investors on the conference call he is confident in his strategy, but should investors be confident in David Solomon? Mike Mayo is Wells Fargo's managing director and head of U.S. large cap bank research. Mike, always great to get some time with you, especially in studio. So David Solomon saying things might be okay, things might be getting better. Should investors believe him?
Well, let's do the short term, medium term, and long term. The short term is this is a situation of sell on the rumor and buy on the news. We had been expecting in our numbers big write-downs. You got big write-downs. And you, as a firm, can't have $1.1 billion write-downs every quarter as you pivot away from consumer, as you pivot away from an acquisition they did, Green Sky, as they pivot away from on these on-balance sheet investments. And by the way, a lot of write-downs for office specifically. So that's what's happening now. So the bad news is out there and the stock's up today. In fact, I actually increased my estimates because you got some of the bad stuff out. In the medium term, it waits to be seen how soon the capital markets come back. You've had lower for longer investment banking. You've had less volatility for trading. So in some ways, it's the worst of all worlds, but the backlog is up at Goldman Sachs versus last quarter. And the question is, how much of that backlog do you convert and monetize to revenues? But the long term is what's really the big question here is. And Goldman Sachs is going back to the future by getting out of consumer, which I thought was stupid day one. You go back, any research, anytime I've been on your show, why were they going?
Nobody's using a Goldman Sachs credit card. I mean, this is Amex. This is Amex land, MasterCard, Visa.
I don't even mean that. I mean like the market's lending. You're going to lead off to the mass consumer in the United States with a lending product. Sure, that doesn't create sticky relationships. And then they go ahead and do that with a savings account by charging. That doesn't create sticky relationships. By the way, look at JP Morgan in London. They lead with a checking account where you interact several times a day. That builds sticky relationships. So I thought it was stupid, and the more it went on, it was even more ridiculous. So better late than never to pivot away from this. But now they're going back to the future. Their legacy over the past 150 years has been serving large institutions. So 2/3 of the company is global banking and markets, where they get mid-teens returns. They have number one leadership in mergers for 20 years. This quarter, equities did great. So that part of the business, nobody has too much question about. Another 1/3 of the company is wealth and asset management. They are doing better in the wealth business, but they have to get rid of some of these principal investments, which is a big drag from a regulatory perspective. And then there are extracurricular activities in consumer and some of these other things that they're getting rid of. So they get rid of the stuff that's extracurricular. They stay in their lane. They pivot and make themselves more balance sheet efficient and more operationally efficient. And then if and when these green shoots materialize, maybe they get from a lowly core, the ROE this quarter was 4%. This was the second worst quarter under David Solomon. Excluding the pandemic, it was the worst quarter in over 7 years for Goldman Sachs. So this is bad. You can't keep doing this. But their goal is to take it from the 4% or 9% adjusted for the charges up to 15% over the next 2 to 3 years. I don't have that. No one in consensus seems to have that. So no one's really believing David Solomon. So the bar is low. They're not trading too far above book value for a company that's grown book value faster than most banks. So I think this is an opportunity. The risk is that it just stays kind of dead money as other things go up. But this is a big pivot. This is a big day for Goldman Sachs. David Solomon is under pressure. So I think over the next year, we're going to have to see, some signs that they're going toward that 15% return.
Mike, do you think Solomon is the right person for this job? Is he going to be able to steer Goldman in the right direction? Because there has been, like you just said, tremendous amount of pressure, not only from shareholders, but even within the firm, from partners who haven't been happy with the direction.
Well, look, like anyone else at Goldman Sachs, David Solomon has to earn the right to be in his job every day. I think from a strategic standpoint, this idea of focusing on two core businesses, pivoting out of the stuff that isn't so core, is the right strategy. So really it just comes down to execution, and can they execute on their plans? And that's why I'm here, that's why you're there, that's why all the eyes are there watching them quarter to quarter to quarter. So right now, David Solomon is still there. Actually, the stock price has outperformed since he's been there. Their capital markets activities grown much faster than the others since he's been there. They've accreted book value faster. So on those metrics, it looks good. But I'm more concerned about the next 3 to 5 years. So yes, David Solomon is the right person at the moment. But, I'm still watching closely quarter by quarter by quarter.
Mike, I've followed your work probably for well over a decade, and there's been a theme during that decade. The leaders that are still operating this business, leading these companies as CEO, are still entrenched. Brian Moynihan, I talked to him yesterday, very much engaged. Doesn't sound like he's going anywhere anytime soon. Maybe Jamie Dimon finally bows out as CEO in the next 2 to 3 years. He's been teasing it for 10 years or whatever it is. Morgan Stanley seeing a change in James Gorman in a year and a half. What has this current guard of CEOs meant to the financial services industry? And is the next crop of leaders, are they as good as these guys?
Well, these leaders were born out of the global financial crisis, which, as you recall, from 2008, 2009, was the biggest crisis since the Great Depression. And so they learned some pretty hard lessons. And so, these are survivors from that crisis. And so what doesn't kill you makes you stronger. And that's certainly the case with Jamie Dimon, which bought Bear and WAMU during the global financial crisis. And then he comes back again and buys First Republic and acts as a leader. So, look, I've had my spats with Jamie Dimon, and I just thought they were spending way too much a year and a half ago. Now they're showing incredible discipline. I mean, what company? You had an IPO on just now about beauty right before oddity. I thought banks might be that's the beauty. Banks are the beast, I guess. So today you have Beauty and the Beast. But what company? JP Morgan just guided for $10 billion higher in revenues between this quarter and last quarter, and guided for 0 increase in expenses. That's amazing. After all the criticism I gave Jamie Dimon, so you're not going to find too many Jamie Dimons coming along. In terms of James Gorman, I said in 2012, I upgraded the stock. I said either the stock price should go higher or he should be fired. And after that, James Gorman, it was an intraday upgrade. After they had a terrible fixed income quarter, James Gorman picks up the phone, calls me. I thought it was a joke at first. And the first reaction by him, and he had his team, I had my team, he said, so that wasn't very nice. And I said, well, I just think the stock should go higher. He goes, so do I, and let me tell you why I think it will. So this idea of not acting defensive, you get red flags when people act defensive. You see it on your show sometimes. But this was the opposite of acting defensive, being open-minded. So I think that sort of open-mindedness, you can have that, you might not have that, but when someone gets in the position, do they actually act that way? And Brian Moynihan, I also thought he should be fired. I went to a special shareholder meeting a decade ago, and he proved me wrong. And frankly, I think I would have said the same thing a decade ago. I'm not sure he was ready to become CEO, but that just grinded out quarter after quarter, year after year, build a better mousetrap. So I think they're all good in different ways. So there's definitely an opening for new leaders to emerge, but they won't have been as battle-tested as James Gorman, Brian Moynihan, or Jamie Dimon.
Point well taken. Mike Mayo, thanks for coming down on a very busy day for earnings. I know you have more to go. We appreciate it. It's a real treat.
Thanks for having me.
Thanks so much.